Okay, welcome back to Accounting 101. This video, we will be going over the end of chapter assignments for chapter 3. So the first thing we have, according to the syllabus, are the review questions 1, 2, 5, 6, and 7. Review question number 1. What's the difference between the accrual basis of accounting and the cash basis of accounting? Well, is when you recognize revenue and expenses. With the cash basis is when cash is paid or received. The accrual basis of accounting, we record revenues when earned and expenses when they're incurred, regardless of when payment is made. Review question number 2. The accrual basis of accounting is consistent with generally accepted accounting principles, the accrual basis. The IRS uses a cash basis, but for financial accounting purposes, we follow GAAP, the accrual basis. Number 5, what are the revenue recognition principles? Okay, under the revenue recognition principle, revenue is determined using a 5-step process or 5 criteria. Step 1, identify the contract with the customer or client. Step number 2, identify the performance obligations required by the contract. What do you have to do? Perform. Determine the transaction price. 4, allocate the transaction price to the performance obligations in the contract. 5, recognize revenue when the entity satisfies each performance obligation. In essence, what it's saying is the company records revenue when the entity satisfies each performance obligation. In other words, when it is earned. Number 6, what's the matching principle? Under the matching principle, expenses are linked to the revenues they generate. Expenses are recorded in the same period as the revenues generated by the expenses. And number 7, adjusting entries are completed at the end of the accounting period to record revenues in the period in which they are earned and expenses in the period in which they were incurred. Adjusting entries also update asset and liability accounts. Adjustments are needed to properly measure net income or loss on the income statement and report the assets and liabilities on the balance sheet. All right, let's go to the short exercises. Short exercise 5, 9, 10, and 11. April 1st, they have a deferred expense. April 10th, they got paid for a service contract that is going to extend 6 months from April 1st through October. That would be a deferred revenue. They got paid before they performed. The deferred expense, the rent, they paid before they used up the rent. April 15th is a deferred expense. April 18th is also a deferred expense. April 30th is an accrued revenue. And April 30th is an accrued expense. Short exercise 9. Okay, I guess they want us to, let's see. Record some things here for a subscription, a magazine. They got, let me do some housekeeping here. So it looks like they got paid by their subscribers $180,000 for this magazine. So the magazine publisher gets the cash of $180,000. Cash is an asset, gets increased with a debit. And they got paid up front before they did anything to their subscribers. So we're going to increase a liability called unearned revenue with a credit of $180,000. Okay. Requirement 2, I guess some of the issues have been mailed to the subscribers. So now we've earned $8,000 of that revenue. That unearned revenue is now earned revenue. So we have to reduce the liability account unearned revenue. Taking it off the balance sheet for $8,000 with a debit. And transferring it to the income statement by putting it into a revenue account, and let's call it something that is somewhat descriptive of it, subscription revenue. And the revenue account is a normal credit balance, so we will credit subscription revenue for $8,000. So, come on. Requirement number 3. Let's see what the T accounts would look like. Revenue. Subscription revenue. So we don't have to do the cash account, but after we ignore the cash account. So once we had the first entry, the credit to the liability account unearned revenue is a credit in the ledger unearned revenue. And then when we go with the second entry, unearned revenue gets a debit of $8,000. And subscription revenue gets a credit for that $8,000. Now we have to figure out the balance of those accounts. Let's knock my ruler off. So when we get done with that, adjusting entry, our balance in the liability account is $172,000, and in the revenue account, $8,000. This has a credit balance because we still owe our subscribers $172,000 worth of the magazines. Here we have the revenue of $8,000 being earned credit balance. Okay, so the next one. Looks like we have an accrued expense here. All right, so the first thing I like to do is break things down to a day here. So they say the payroll was $12,500 for a 5-day work week. $12,000 for a 5-day work week. So divide the 12,005 by 5, and that's $2,500 a day. $12,500 divided by 5 days, $2,500 per day. Now, how many days were worked? Monday, Tuesday, and Wednesday. I count 3. So now we can multiply that by 3 days. We'll figure it out, $2,500 per day, 3 days, Monday, Tuesday, and Wednesday. 3 times $2,500, $7,500. So that's the salary expense that was incurred but not yet paid to the employees for them working on Monday, Tuesday, and Wednesday. Okay, so now the entry would be December 31st, accrue that expense, salaries expense, and credit the liability salaries payable for the amount we just computed, $7,500. Okay. There's the entry. Salaries expense, $7,500. Salaries payable, credit, $7,500. Post them to the T accounts, respectively, in the general ledger. Put the liability first, since it would have a account code beginning with number 2. The expense, salaries expense, would have a account code beginning with the digit 5. So we have $7,500 in accounts payable, liability account, and our salaries expense had $620,000 balance in it for everything before, all the payrolls before. That's from the adjusting entry. This is the balance that's in the salary expense account for January, February through the middle of December, the last payroll made in December. But we have to increase it for this adjusting entry, $7,500. And that will give us a balance of $627,500. Right down here. That's from the adjusting entry. That's from the adjusting entry. There's the debit for the expense. There's the credit for the liability, salaries payable. Okay. Let's see, that was number 9. Now we got to do number 10. Oh, I'm sorry. We got to finish requirement 3 for number 10. Making the payroll, paying the employees on January 5th. All right, so we're going to pay the employees $12,500 we normally pay them every 2 weeks, right? Or every week, I'm sorry, every 5 days. Okay, so there's my disbursement of cash. Cash is an asset, it's going down, so I credit it. Now, what does that $12,500 payment take care of? Well, the salaries expense for what? Thursday and Friday, right? $2,500. So I have $5,000 in debits and $12,500 in credits. The difference being $7,500, which takes care of the salaries payable created from the adjusting entry on December 31st for the 3 days worked. All right. So that $12,000 payment, $500 payment satisfies the salaries payable of $7,500 for Monday, Tuesday, and Wednesday, which was last year. And the difference for Thursday and Friday is the salary expense for this year, for the current year, subsequent year, for January, Thursday and Friday, the first Thursday and Friday in January. All right, 11. Short exercise 11. Okay. All right, so we had interest here, huh? $33,000 loan times 6%. So that'd be 0.06. Well, let's see what that's going to be. 30,000. 6 would be $1,800. Yep. But that's for a full year. Okay. Interest rates, whenever you see an interest rate and it doesn't say anything, the assumption is that is an annual interest rate. Now, how many months do we have here? When did the loan originate? September, October, November, December, 4 months. So we have to take 4/12 of that, $1,800 interest. I'm going to just label it interest over here. $1,800 times 4/12 of a year. And that's $660. Okay. The interest is going to be paid back at the end of 1 year, along with the principal, the amount of money borrowed. So we have to pay back the money you borrowed plus the interest on it. So we're going to have to pay back $34,800 when the loan has to be paid off. So on December 31st, we have to do an adjusting entry for the accrued interest and accrued expense. So I'll call it what it is, interest expense. And we computed it for the 4 months to be $660. And we have an accrued expense, so it'll always go to the name of the expense, followed by the word payable, so it'll be interest payable. $660. Debit to increase interest expense, credit to increase the liability interest payable. It'll be paid off when we pay the loan off in 1 year, or actually in 8 months. So what do we got here? Do the balance. So we have interest payable. And interest expense. And the payable, the credit comes over. And the expense has a debit. Both $660. So that's what the general ledger accounts for those two accounts would look like. Now, they didn't ask for it here, but I'm just going to show you what happens on October 1 of the subsequent year. I'm sorry, September, October, November, December. September 1. It could be August 31st. I don't know how the loan agreement is written up. Okay. But the loan is going to be, the origination of the loan, we would have debited cash for the $33,000 and credit note payable. So now the note payable is going to be paid off. The liability is going to be, our obligation under the liability is going to be satisfied. So note payable, it's a liability, had a credit balance. So to get rid of it, we debit it, $33,000 debit to note payable. Cash is going to be $34,800, the $33,000 principal amount plus the $1,800 interest. Okay, I had a little. So that $34,800 payment of cash back to the bank is going to extinguish the liability on a note payable. It's also going to extinguish the interest payable we incurred when we did the adjusting entry. On December 31st. For $660. My debits and credits still don't balance. The difference there, let's see, that's 33,000 equal 34,800 minus 660. 34,800. Is 1140. Okay, so now my amounts in my debit and credit columns total. I just have to figure out what that is. Well, what would that be? That would be the interest expense for January through the end of August on the loan. And there's your journal entry when you pay the loan off. They didn't ask for it, but I figured I'd show it to you so you would see the entire life of that loan. All right. Up next, we have exercise 21. Here's the exercises. $21 and $22. Okay, so what do we have here? Looks like we have some adjusting entries, which is good because that's what the chapter is about. So on January 1st, we had a situation where we got paid in advance. So we had a deferred revenue situation. So now on January 1st, let me just put in here. I'm not sure. Exercise. 3-21. Okay, so on January 31st, let me draw my column for my debit and credit amounts here. Debit and credit. We are going to reduce that liability unearned revenue for the amount that was earned. So we're going to reduce the unearned revenue liability account with a debit of $320, and I'll show you the computation for that shortly. And we're going to put it into a service revenue, a revenue account, taking it off the balance sheet, getting it onto the income statement. $320. There's the adjusting entry. Okay, so the contract was on January 1 for 10 months. January, February, March, April, May, June, July, August, September, October. To October 31st. 10-month contract. Okay. Total of the contract was $3,200. And the amount paid to us in advance. So divide that by 10 months. And that's $320 per month. Total of the contract, $3,200. 10-month contract divided by 10 months, $320 per month. So how much was earned during January? $320. So that's what we reduced the unearned revenue by, the liability, put it into a revenue account for the income statement, $320 for the month of January. Now, it says we had salary expense here, huh? Oops, went too far. What do we got here? We paid the employees $3,600 a month. And it looks like we pay them on the 15th and the 1st. So we pay them twice a month. So she pays a month. So $1,800 each pay. Now, since they pay on the 15th of the month and the 1st of the month, or the 1st of the 15th, the employees worked during January, from January 16th to January 31st. They're going to get paid on February 1st. So we have an accrued expense here. So on January 31st, we have to do an adjusting entry to recognize the fact that the employees worked the second half of January, but didn't get paid yet. So it's an accrued expense. So we have salaries expense being debited and a credit to salaries payable. Yeah, they'll be paid the next day, February 1st. But if we're doing financial statements, everything would be, not everything, but salaries would be out of whack, and liability, salaries payable, would be out of balance. It would both be understated if we didn't do the adjusting entry. So there's the adjusting entry. Increase salaries expense with a debit of $1,800. Increase the liability salaries payable for $1,800. Okay. Then it looks like we had an accrued revenue, or we did work but didn't get paid. in January. Yeah. So we need to do an adjusting entry to get that revenue into January. We did the work. Receivable and a credit to service revenue for the $1,600. The amount earned in January. And finally, looks like we had some interest expense. So we're going to accrue the interest expense with a debit, increase it for $53, and credit a liability account called interest payable. $53. Okay. Exercise 3-22. All right. What's going on here? I have to do some adjusting entries. Okay. They're all December 31st, which I'm going to put up here at the top of the page. And then I'm just going to use a letter to highlight or reference the adjusting entry. Credit columns. Okay. So A, unearned revenue. It was collected in advance. We've got to do a computation here. So let me get another piece of paper going here so I don't keep the entries looking nice. My volume's up here. All right, so what do we have? We had $3,000 rent collected in advance. And that was for 1 year. All right, so divide that by 12 months to get a monthly rental amount. It'd be $250 per month. Okay, that was October 1st. Where are we now? December, October, November, December, 3 months. October, November, December. Okay. So this is situation A. So the information they gave us for A. We received $3,000 for 1 year lease. October 1 through the following October 1, September 30th. Divide that by 12 months to get the monthly amount of $250. And then how much did we provide? How long did we allow them to use our property that we're renting to them? October, November, December, it's 3 months. So we get the monthly amount, multiply by 3, and we get $750. That's the amount we're going to use for the adjusting entry. Unearned revenue is going to be decreased. Again, think about what happened when we got the payment. We would have debited cash for $3,000 and credited unearned revenue. So now with the passage of time, we have to decrease that liability for 3 months, October, November, December, at $250 a month or $750. And then we also have to recognize the income. We call it rent revenue. rental revenue, rental income. So there's the adjusting entry for situation A. Okay. B. Looks like an accrued expense with payroll. So let's see. It says $1,800 per day. And how many days do we have there? 4 days. That's going to be $7,200 from Monday, Tuesday, Wednesday, and Thursday. There's the computation. $1,800 a day for 4 days: Monday, Tuesday, Wednesday, Thursday. $7,200. So we're going to increase the salaries expense, $7,200, and increase the liability account corresponding to that. So call it salaries payable. The liability account gets increased with the credit, and that's what it would look like. Situation 3, or adjustment C, I'm sorry. We have some office supplies here, huh? So we had the balance in the account being $3,000. My phone is ringing. Hold on, I'll be right back. Hello? Yes. Yeah. What time is it now? Yeah. 10:15? Okay, yeah. All right. Thank you. Bye. All right. Where were we? Oh, the office supplies account has a balance of $3,000. They tell us it should have a balance of 1,900. So the account shows us one thing. Reality tells us something else. So how do we go from 3,000 down to 1,900? The amount on hand. We have to reduce the office supplies account by $1,100. That's the amount that was used up. So this is kind of easy, straightforward if you think about it. The asset office supplies are being reduced. They're going from 3,000 down to 1,900. So they're going to be credited for $1,100. Supplies. And we call the debit supplies expense. Okay. D. Let's go back up and see what D is. Oh, they tell us depreciation expense on the equipment was $500. Whenever we have this depreciation expense, it'll be given to us, and The offsetting credit goes to an account called accumulated depreciation. Now notice the depreciation expense hyphen equipment, accumulated depreciation hyphen equipment. Very important, because if we had a building or we had a vehicle, each of them has their own depreciation. Each of them has their own accumulated depreciation account. All right, so adjustment item E. Looks like we had prepaid insurance. So this is a deferred expense. So we got to do a little computation here. We paid $4,320 for 2 years. And that was on April 1 of the current year, for a 2-year insurance policy, prepaid. That's 24 months, 2 years, right? So again, I want to break it down into months. So take 4320 divided by 24, and I get $180 a month. Okay. So how many months expired? How much insurance expired between April 1st and December 31st? April, May, June, July, August, September, October, November, December. 9 months. So $180 a month times 9 months gives us $1,620. There's the computation. All we have to do now is do the adjusting entry. So we originally would have had a debit to prepaid insurance, credit to cash for the $4,320. So now the amount we just computed of $1,620 represents the amount of insurance used between April 1st and December 31. So we're going to reduce the asset, prepaid insurance, with a credit. And the offsetting debit will go to an account called insurance expense. We had an asset. Some of it has been used up or consumed. So we're going to recognize that the part that has been used up, the insurance that has been, coverage that has been used between April and December, we're going to reduce the asset, prepaid insurance, and it's going to be transferred to an insurance expense account. All right. I think that's it, huh? On that one? Yeah, 23. Let's start next. 21 and 22. Okay, so now we have to go to the problem. Problem 35A. Let me just find it here. Scroll down. 32, 33, 34, 35A. Okay, here we go. Problem 3-35A. Again, that'll all be December 31, but I'm going to use the letters here. And what do we have here? Record service revenue that was earned, that was collected in advance. So in A, we're reducing the liability unearned revenue and transferring it to a revenue account, taking it from the liability account, putting it into the revenue account. The amount was $2,100. I'll say computation, so that must be given. That is to record when you earn that was collected in advance. So we had a deferred revenue situation here. Okay. B, we had a prepayment of rent. We had two. If you go to the trial balance, you see we had $2,900 of rent, prepaid rent. And that's for 2 months. So divide that by 2, and we get $1,450 per month. All right. So on December 1st, we prepaid for 2 months worth of rent. At the end of December, half of it is gone. So $1,450 has to be recognized as a rent expense. And the asset prepaid rent has to be reduced by $1,450. Okay, supplies on hand, $750 were used up. So we have to reduce the office supplies. Again, with office supplies, be careful when you read the information, how they present it to us. Sometimes they will tell us, the last one we did in the exercise, they said what the balance was. The balance in the account and the amount on hand. So we had to compute how much was used by taking the difference. Here they tell us how much was used. So they're telling us the amount of the expense, so we don't have to do a calculation. We just have to write the journal entry to recognize the supplies expense with a debit of $750 and a reduction of the asset office supplies by a credit of $750. Item D, they are giving us the information about the depreciation expense on the equipment. So only thing we have to do at this point in time until we figure out how to compute depreciation in Chapter 9 is record the expense with a debit, and then the offsetting credit goes to an account called accumulated depreciation on the equipment of $850. Advertising expense in E, A, B, C, D. They said I had an accrued expense, use accounts payable, so the advertising expense is going to be increased with a debit and a credit to accounts payable. $1,100. Next one we have is the salaries expense. Let's see, we have to do a computation there. The payroll is $5,250 for a 5-day work week. Divide that by 5 to get the daily amount. That works out to $1,050 a day. And they have Monday and Tuesday before the end of the year. So multiply that by 2 days for Monday and Tuesday. And it would be $2,100. 2 days, Monday and Tuesday, times the $10.50 per day, $2,100 total. So this would be EF, would be the adjusting entry. So we're going to increase the salaries expense with a debit of $2,100 and credit a liability account called salaries payable for the same amount, $2,100. And finally, G, I think it's the last one, accounts receivable, 2250. Let's see how computation with that. Oops, I went too far. All right, I guess I can fit it on the bottom here. $3,400 contract. Service revenue, October through January, 4 months. So divide by 4 to get a monthly amount. And you get $850 per month. And how many months expired between October and December 31? October, November, December, 3 months. So multiply by 3 months. October, November, December. 2550. Total contract was $3,400 for 4 months. We completed 3 months worth of work. Take 3/4 of that $3,400, or do it like I did, break it down by a monthly amount. $3,400 divided by 4 months gives you $850 per month, times 3 months, $2,550. We have to recognize as earned. So we didn't get paid yet. We're going to get paid at the end of the contract. So accounts receivable gets the debit of $2,550, and service revenue gets the credit for the same amount, $2,550. Okay. The rest of this I'm going to have to do on another video. I'm running out of time here. I have an appointment. I didn't know it was going to take this long. So I'll finish up problem 35A later today and get it out to you. I'll send these out in conjunction. There'll be 2 videos. I'll have to split this up. All right.